Welcome back to the deep dive. Today we are strapping in for a really high-stakes, comprehensive look at the global financial landscape. We're looking at the data as of November 18th, 2025.
That's right. And this isn't just a simple, what happened yesterday market recap.
No, not at all. We have this powerful stack of material. It's a snapshot, really. And it is just screaming one thing to institutional investors everywhere.
Extreme caution. That is the fundamental takeaway.
Exactly. So our mission today, and really for you, the listener, is to cut through all that daily market noise and understand what feels like a seismic shift happening right now.
It is. We're seeing this rapid move away from what was, for years, an environment of growth enthusiasm.
Yeah.
Chasing high beta returns, that whole risk-on mood.
Right.
And we were moving very quickly into a strict, almost punitive environment of risk aversion. It's about self-preservation now.
And that transition, it's not simple. It requires a complete overhaul of how you view assets, how you view safety itself.
It does. And we're not just talking about standard market volatility here. The sources we've got paint a very specific, and I have to say, a very concerning picture.
Highly stressed markets, for one.
Highly stressed. We've got these significant, very high-profile warnings about deep overvaluation. And it's not just in one asset class, it's stretching across almost everything.
And maybe most importantly, we're seeing capital flows physically changing direction.
Yeah.
Money is moving.
Yes, so this deep dive is really a masterclass in global risk management. It's about understanding that deep interconnection.
That what happens in, say, Tokyo or London has a direct, dramatic effect on your balance sheet, on your operational supply chain, wherever you are.
Absolutely. And if you need that one immediate nugget, that one piece of information to understand the urgency of this environment, it's this.
What is it?
A major defining warning from arguably the world's most influential fixed income investor, the bond king.
Okay.
That warning is driving this massive psychological and strategic shift to defense. You have to unpack that first.
Yeah, that seems like the right place to start.
It sets the tone for everything else we're seeing across the board in global indices, in currency markets, and especially in those high-flying tech valuations.
Okay, let's do it. Let's unpack this alarm bell. So the whole atmosphere right now really feels like it's being set by one person. Jeffrey Gundlach, the bond king.
That's right.
For anyone who might not be familiar with his standing, I mean, he manages billions. His insights into the bond market, which is really the foundational plumbing of global finance, his words are basically gospel for institutional money.
When he speaks, the market listens. There's no question.
But the severity of his warnings right now, they feel particularly acute. This isn't just, gentle advice about trimming a position here or there.
No, this is a retreat signal. A full-blown, unambiguous alarm bell demanding that you pull back.
So what's his core argument? What's the main warning?
The core warning, when you synthesize it from the sources, is just this broad indictment of the entire pricing structure of the financial ecosystem. He's arguing that most financial assets, yes, most, and he explicitly calls out both stocks and bonds. He says they're experiencing severe overvaluation.
Wow. Okay, that is a staggering claim. Because if both stocks and bonds are overvalued at the same time, that means the very bedrock of modern portfolio theory, the idea that they move inversely, is broken.
It's broken. It implies there's almost nowhere safe to hide if the entire market is structurally inflated.
So how did we get here? How can everything be inflated at once?
Well, that's the essence of the problem, and it's why his warning is hitting so hard. Think about the last decade. You had historically low interest rates, massive central bank intervention, quantitative easing.
And pumping money into the system.
Exactly. Pumping incredible amounts of liquidity into both the equity markets and the fixed income markets. And that created what a lot of analysts are now calling the everything bubble.
The everything bubble. I've heard that term.
And now, with inflation creeping up, with all this uncertainty around rates, that liquidity is draining out of the system. And it's exposing these underlying, really stretched valuations in both types of assets.
And he doesn't just stop at a general warning, does he? He gets very specific about where investors should be fleeing from.
Oh, very specific. Let's start with his assessment of the U.S. market.
Okay.
He explicitly, and this is a huge deal, recommends reducing exposure to the U.S. market.
Which has been the best performing market for a decade.
By far. And it dominates global benchmarks like the MSCI World Index. So for him to say that, it's a profound statement of doubt in the near-term performance of the U.S. It suggests that, relative to the rest of the world, U.S. asset prices are carrying the most systemic risk.
But the detail that really just jumps off the page for me is how he attacks the foundation of, well, of modern retirement investing, the 60% stock, 40% bond portfolio.
The 60/40.
Yeah, the 60/40. That strategy has been the standard blueprint for diversification and moderate growth for, what, decades? Why is it suddenly broken?
Well, that's really the second key point of his analysis, the shift in traditional strategy. Historically, the 60/40 worked beautifully. Stocks gave you growth, and when stocks did poorly, say, during a recession,
Bonds would rally.
bonds would rally, interest rates would fall, and the bond portion of your portfolio would provide this protective cushion. They had a reliable negative correlation.
They were the perfect risk offsets for each other.
They were. But Gundlach is essentially arguing that the standard 60/40 is no longer fit for purpose. The risk environment has changed so dramatically.
Oh.
Because when both asset classes are overvalued at the same time, they lose those offsetting properties. Bonds no longer effectively hedge your stock risk.
Why not?
Two main reasons. First, interest rates are unpredictable. So bond prices might actually fall right alongside stocks. You lose the hedge.
Okay, that's a big problem.
It's a huge problem. And second, the long duration of many fixed income products, that's just their sensitivity to rate changes, means they carry their own significant valuation risk now. So they aren't the safe haven they once were.
So if that defensive shield is broken, what's the repair strategy? You can't just do nothing.
The repair strategy he lays out is deeply defensive and very specific. He's saying you have to adjust your portfolio structure because the systemic risk is just increasing. Volatility management is everything now.
And his recommendation is pretty stark.
It is. He recommends that stock holdings should be held at less than 40% of the total portfolio.
Less than 40. So going from a standard 60% down to below 40, that's not a tweak.
No, that's a structural, deeply defensive posture. It suggests he sees a very high probability of a severe market correction coming.
That is an aggressive reduction in risk. So if you're shedding all that equity exposure, you have to be building up something else. What are the specific moves he's recommending?
His recommendations outline a clear path towards liquidity and what he sees as relative value. First, and this is the big one, he's calling for a major increase in cash holdings.
Cash. So cash is king is back.
It's back in a big way. Cash becomes the critical asset when you expect future returns to be poor. And it gives you optionality, the ability to buy assets on the cheap after a market collapse.
Right, so you're waiting for a massive sale.
In a panic, cash is the only asset that guarantees stability and the freedom to maneuver. That's his view.
Okay, so more cash. What's the second move?
The second move is where it gets more nuanced, and it's essential to understand this. He recommends a reduction in gold holdings.
That's surprising. Gold is usually the ultimate safe haven during turmoil.
It usually is, but apparently it's not viewed as attractively priced enough right now to maintain a heavy allocation. This is a really critical insight into his thinking.
So why reduce gold if you think we're heading into a storm? Is it just to raise cash?
It's likely a mix of factors, all driven by this overwhelming fear of liquidation, a forced liquidation event.
What does that mean?
It means when markets really panic and major institutions get margin calls, meaning they have to post more collateral because their assets are falling in value, they sell whatever is liquid and whatever they have a profit in.
And that often includes gold.
It often includes gold. In a massive deleveraging event, everything gets sold to raise cash. All those traditional correlations just break down. So Gundlach is prioritizing pure cash over gold's historical inflation hedge property. That signals that liquidity is the immediate #1 concern.
Okay, cash over gold. And the third major move is a geographical one.
Right. Yes. While he's warning against the highly valued U.S. market, he suggests investors should look more towards emerging markets.
Now, wait a minute. That seems contradictory. Emerging markets, or EM, are historically more volatile. If the whole strategy is about defense and liquidity, why would you risk going into higher beta markets?
But that is the essential question you have to ask.
They usually fall harder than developed markets in a downturn.
They do. And the answer really lies in the concept of relative valuation. It's not a bullish call on EM in isolation. It's a strategic decision. It's about the difference between the risk you're taking and the potential reward.
So they're just cheaper.
They're much cheaper. Compared to the severely overvalued U.S. and other developed markets, EM often trades at significantly lower price-to-earnings multiples. So while the risk of volatility is higher, the potential upside, if global growth stabilizes, is structurally better because you're starting from a lower price.
So you're fleeing expensive risk for what you hope is cheaper risk.
Exactly. The margin for error in the valuation is just larger.
If we pull all this together then, this entire set of advice, it's the clearest signal we have that this deeply defensive psychology is just dominating the market narrative right now.
It is. This isn't just pessimism. It's a strategic, tactical retreat. And it's all driven by the belief that these high prices simply cannot be sustained. It's a fundamental repricing of risk across the board.
And when a guy handling billions starts questioning the very bedrock of portfolio management, you know the atmosphere is
Well, it's compromised.
severely compromised. So we've established this severe warning from Gunluck. Now let's see how that defensive fear is actually showing up in the real world. We can move from the abstract advice to the concrete impact on global indices as of November 18th.
Right, because this shows the contagion effect. It proves these fears are already migrating across continents in real time.
The pressure really is visible everywhere, isn't it?
It is, because market participants, they're all reacting to the same core fear, overvaluation and the threat of a future economic slowdown. When the world's most powerful investors start to sell, everyone else scrambles to figure out why, and that just causes this widespread weakness.
Let's start with Europe. The UK gives us a pretty direct view into the health of the consumer and the financial system. What are we seeing there?
In the UK market, which is tracked by the FTSE 100, we saw a slight decline. But what's really telling is what led that decline.
What was it?
The banking sector. It was explicitly identified as the leading drag on the entire market.
And banking stocks are highly cyclical.
Extremely. Their profits are tied directly to the health of the economy, to credit quality, to the mortgage market. So they're like a canary in the coal mine.
So if the banks are leading the way down, what specific concern is driving that? It's not just random, is it?
No, it's not random profit-taking. It's explicitly tied to worries about incoming weak economic data and, crucially, the future path of interest rates.
Okay, so what's the fear?
Investors are afraid that a slowing economy is going to lead to higher loan defaults, especially in things like property and consumer credit. And that eats directly into bank profits.
And what about the interest rates?
Well, if the UK central bank continues to signal unpredictability or, higher for longer rates, the funding costs for banks go up. So investors are basically selling off the most sensitive, most leveraged parts of the economy first. They're anticipating a downturn in the credit cycle.
And we see a similar thing happening halfway across the world in the Asia-Pacific region, right? What's the read on the Australian market?
A very similar story. The Australian market, the ASX 200, it opened lower. Specifically, it was down by about 0.8%.
And the context there is key.
The context is everything. That decline happened immediately after a strong negative session in the U.S. It just demonstrates how interconnected global risk sentiment is. U.S. selling pressure translates almost instantly across time zones.
So it forces investors in the APAC region to de-risk before their own local data even comes out.
Exactly. They're reacting to the global mood.
So what are Australian investors focused on right now with all this global turmoil swirling around?
Their main focus is on domestic data releases. They're waiting for incoming figures on wages and on the consumer price index, the CPI.
So inflation and wages?
Right. For anyone who's not deep in finance, CPI measures inflation, and wages are a key driver of inflation. If those numbers come in hotter than expected, it basically forces the Reserve Bank of Australia's hand.
They'd have to raise rates.
They'd have to consider it, which leads to tighter money, which then exacerbates all those banking sector worries we just talked about. In this kind of defensive environment, every single data release becomes a high-risk event that could trigger more selling.
It really feels like everywhere we look, the weakness in stocks, whether it's banks in the UK or the broad index in Australia, it's a direct reflection of those valuation fears that Gunluck articulated.
It is. And that brings us directly to the engine of the market for the last few years, the technology and AI sectors.
Right. The analysis of the valuation concern there is critical because that's been the source of so much of the growth and the enthusiasm, not just in the U.S., but globally.
And Gunluck's broad warning is being cited as one of the key signs that these high-flying tech and AI sectors might be, well, overly inflated, built on assumptions that just cannot be met.
They are inflated. How do you put that into perspective for someone?
Okay, imagine you're pricing a massive skyscraper. But you're not pricing it based on the current tenants and the rental income it's generating now. You're pricing it based solely on the promise that the entire neighborhood around it will become the world's biggest commercial hub in 5 years.
That's a big promise.
It's a huge promise.
Yep.
And that's what's been happening in tech. The valuations are built almost entirely on future, exponential, and frankly, often unrealistic expectations for growth, for profitability, and for adoption.
So if those high expectations for revenue, for adoption, whatever it is, if they don't materialize exactly as predicted, the consequence isn't a gentle slowdown.
No, the source warns that if those expectations fail, even slightly, a severe market correction could occur. We're not talking a 5% dip here. A correction in this context means a significant sudden drop in prices because the entire justification for that high multiple just vanishes.
And the pressure isn't just limited to stocks, is it? We often think of a correction as just an equity market thing.
Not this time. The source material really reinforces the true breadth of this correction. It points to a completely indiscriminate sell-off.
There's a specific quote, isn't there?
Yes, it's a very visceral observation. It says, market rout intensifies, sweeping up everything from tech to crypto to gold.
Everything.
That's the ultimate evidence of this defensive psychology taking over. When capital is just prioritizing liquidity, they are not differentiating between asset classes.
So the market is hammering high-risk, high-reward assets like crypto and historical safe havens like gold at the same time. What does it signal when all the correlations go to one and every asset class is moving down together?
It signals pure panic
Mm-hmm.
and massive deleveraging. It means investors are just fleeing to the sidelines, building up those cash holdings exactly like Gunlike recommended.
And the fact that gold is getting swept up in it.
That's the real tell. If gold, which is supposed to protect you from market turmoil, is getting sold off, it signals institutional forced selling. It means margin calls are being met by liquidating your most valuable assets regardless of their fundamental safety profile. The search for safety has become so desperate it's creating chaos, even in the traditional safe havens.
Okay, let's try to connect this chain of events. So capital is fleeing what it sees as overvalued U.S. stocks. Traditional safe havens like gold are also being stressed because of these liquidation demands. So where is all this money actually going? Where is it finding a home?
And the answer we're seeing in our sources is probably the most surprising geopolitical dynamic of the week.
The euro.
The euro. This is maybe the most fascinating financial dynamic of late 2025. It represents a subtle but really powerful shift in the global financial architecture. We're witnessing a clear change where traditional roles are being challenged.
The euro is emerging as a new preferred safe haven. That just runs completely counter to the last few decades of history, doesn't it? The U.S. dollar has always been king during a crisis because of its liquidity and its reserve status.
Precisely. The euro is beating that safe haven status and is contrasting sharply with the traditional choices, the U.S. dollar and the Japanese yen.
It's leapfrogging both of them.
Which is a massive red flag about the perceived stability of both the U.S. and Japan right now.
So let's break that down. Why is this happening? Let's start with the U.S. skepticism. Why is the U.S. dollar being shunned in this moment of crisis?
There are two specific interconnected drivers, and they're both rooted in this deep skepticism about U.S. market and monetary leadership. First, you have growing investor concern about U.S. technology performance.
The engine of the market.
The engine of the market. When investors fear that the U.S. tech sector, which just dominates the U.S. indices, is inflated, they pull capital out of U.S.-denominated assets. And that means they have to sell the U.S. dollars they were using to hold those assets.
Okay, that makes sense. And the second point is about stability, right?
Yes. The second reason is the increasing uncertainty and changes in U.S. monetary policy. The future direction of the Federal Reserve, maybe it's driven by unpredictable inflation or political pressure or just aggressive policy swings. It's creating volatility in the dollar.
The market hates uncertainty.
Hates it. And the U.S. has high debt levels, aggressive fiscal policy, and that erodes the long-term perceived stability of the currency. I think the market is just getting tired of the roller coaster.
And what about the Japanese yen? That's been the quintessential safe haven currency for decades because of Japan's low interest rates.
The yen's status is eroding. It's because of a lack of yield and these persistent structural issues in Japan's economy.
But it's still safe, isn't it?
Well, it still offers safety because Japan is a massive creditor nation. But when global risk aversion spikes, you get this unwinding of the famous carry trade investors who borrowed cheaply in yen have to buy it back. And that creates these sharp, unpredictable swings in the yen that a lot of defensive investors just want to avoid right now.
So the euro, by contrast, seems more stable.
It offers relatively higher rates and, at this moment, greater perceived monetary stability compared to the yen.
So why Europe then? What are the specific factors that are making the euro look so attractive and stable?
We have three clear drivers listed in the sources. First, we're seeing increased direct investment flowing into Europe. This isn't just hot money fleeing the U.S., it's capital that is actively finding value.
So European assets are cheaper.
Comparatively, yes. European equities and bonds often trade at lower PE ratios than their U.S. counterparts. They're offering better entry points for value-conscious investors.
And that capital fleeing U.S. tech, where is it landing in Europe specifically?
It seems to be landing in assets that are perceived as defensive and stable. Think about things like German bonds. That's the German equivalent of U.S. treasuries. Or high-quality defensive European industrial stocks or luxury goods companies.
Companies with pricing power.
Exactly. They offer stability and less exposure to the volatile global tech cycle. This shift represents a very deliberate move toward a less volatile, well-diversified zone.
And the final piece is the perception of the ECB versus the Fed.
Absolutely. The Eurozone, for all its internal complexities, it offers a broad, multi-nation central bank structure in the ECB. And right now, that structure is being viewed as offering greater long-term monetary policy stability than the highly politicized and sometimes unpredictable policy swings we're seeing from the Federal Reserve.
So if we connect this to the bigger picture, this whole currency shift, it signals some genuine deep-seated doubts about long-term U.S. fiscal and monetary dominance.
It does. It's forcing portfolio managers to seriously reevaluate their U.S. dollar exposure. And it's proving that there is now a credible, liquid alternative for crisis capital to flow into.
All right, let's shift our focus now from capital markets and currencies to the foundational economic health of nations. Because these market valuation fears, they don't exist in a vacuum.
No, they're a reaction to the fundamental macro data.
And we need to highlight some specific contraction signals that should probably worry every CEO and business leader globally, no matter what industry they're in.
The Global Economic Health Check is revealing some significant, very concrete red flags. We are not talking about forecasts of slow growth here. We're talking about outright measurable economic contraction.
In major developed economies.
Yes. Which major economies specifically announced this news?
It was Japan and Switzerland.
Exactly. Japan and Switzerland both recently announced their economies contracted in the previous quarter. And these are not small peripheral economies.
Not at all. Japan is an export powerhouse, a major financial center. Switzerland is the global hub for banking, high-end manufacturing, pharmaceuticals.
So a simultaneous contraction in two economies like that, that is a massive structural headwind for any kind of global optimism.
And the sources gave us very specific reasons for what caused this contraction. It's helpful for diagnosing the global illness, so to speak.
Yes, there were two primary factors cited. Both are highly political and macroeconomic in nature.
What was the first one?
First, exports were negatively impacted by U.S. tariffs.
A direct consequence.
A direct, measurable consequence of protectionist trade policy, bleeding directly into global economic performance. When the largest consumer market in the world, the U.S., puts up trade barriers, it immediately stifles the economic engines of export-heavy nations like Japan and Switzerland.
So that's a clear, quantifiable link. Trade wars have real costs that hit industrial output first.
Absolutely. And the second factor that was cited was reduced tourism activity.
Okay.
Tourism is a huge component of service economies, especially in places like Switzerland and Japan. A drop there suggests diminished global consumer confidence, reduced discretionary spending across borders.
People just tighten their belts and stay home when financial fear is high.
That's right. So the importance of this data, it isn't just about those two countries' GDP reports. It signals a much broader fragility.
It's a warning sign.
A very clear warning sign about the health of the entire global export supply chain and about overall global growth. If the machinery of global trade is slowing down in these bellwether economies, if Swiss precision manufacturers are selling less and Japanese auto parts suppliers are seeing demand drop, it means everyone who relies on international sales is facing a tougher environment.
And this is where it gets really interesting. We can bring this macro environment directly back to you, the listener, who might be operating in a very specialized field, like testing and molecular biology.
Right.
How does a tariff dispute between the U.S. and Japan translate into operational risk for a specialized scientific organization? This is the critical connection to make.
And this is exactly why the source explicitly warns that this macro environment needs to be noted. Because it affects a sophisticated industry like yours. It's not a direct hit, like a stock drop. It's an indirect structural weakening that impacts the cost of doing business.
Okay, so let's get specific. What are the areas of operational impact for our listener? Let's start with operating costs.
Think about your operating costs. A molecular biology lab relies heavily on specialized reagents, consumables, high-purity raw materials.
And many of those are sourced globally.
Many are sourced globally, often from Europe, Germany, Switzerland, or from Asia. If tariffs are causing disruptions, or if currency volatility like the euro gaining on the dollar, as we just discussed, makes your international purchases unpredictable, the cost of those imported materials goes up, and it becomes far less predictable.
You can't run a precise experiment with unpredictable costs.
You can't. And this feeds directly into the second point, which is your long-term investment decisions for capital expenditures.
It becomes much harder to justify big investments.
Much harder. If your firm relies on venture capital or institutional investors or even just bank financing for expansion or for funding R&D on new molecular diagnostics, that money is now harder to get.
Why?
Because the financial institutions are all in that defensive liquidity hoarding mode. And they view specialized R&D as a high-risk, long-timeline investment, especially in a contracting economy.
And the final, and maybe the most tangible piece, is the cost and availability of highly specialized imported equipment. I mean, molecular biology requires sophisticated precision machinery.
Absolutely. German, Swiss, or Japanese optics and robotics are often the gold standard.
So this raises a really important question. How does a global export slowdown translate immediately to your operational decisions?
The answer is supply chain fragility. If Japan and Switzerland are contracting because of hits to their exports, the manufacturing and logistics for that specialized scientific equipment, we're talking high-end mass spectrometers, sequencers, clinical testing robots, all of that could be impacted.
Which means longer lead times.
Extended lead times, higher prices due to tariffs, transportation costs, currency swings, or even reduced availability of critical servicing parts. You need financial stability for predictable supply chains. And when that stability erodes globally, your critical equipment is at risk.
So you have to start budgeting for more cost uncertainty and significantly longer waits for mission-critical equipment.
You have to. It becomes an operational imperative.
We've covered the panic, the defensive strategy, the global contraction. Now let's circle back to the U.S. market for a more conditional outlook from Morgan Stanley. This gives us a bit of a different perspective. It suggests opportunity might still exist, but only for those who can navigate these extremes.
Right. Morgan Stanley offers a really crucial counterpoint to the sort of total pessimism of Gundlach. But it comes with very, very heavy caveats. We need to analyze their perspective on the S&P 500, which is the key benchmark for U.S. equity health.
They adjusted their target for the S&P 500. What was the positive rationale behind their outlook? How does it contrast with Gundlach's fear?
The positive news they cited is that earnings per share, or EPS, are projected to increase in the coming years.
Okay.
This suggests that American companies, especially those outside that hyperinflated speculative tech bubble, still have the underlying capacity to generate higher profits through efficiency, productivity gains, domestic market dominance. There's still fundamental business health in the U.S. economy that's producing wealth.
But wait, if earnings are projected to rise, why is the market still in such a state of fear? Why the talk of overvaluation? That seems contradictory.
And it goes right back to that core theme we've been hitting on. Valuation versus fundamentals. The persistent problem is the valuation.
The price you pay?
The price you pay. Morgan Stanley notes that despite the projected rise in earnings, the current market price remains significantly higher than historical averages.
So even with good news, the market is still expensive.
Exactly. Even though the earnings engine is strong, the price you are paying for those earnings is still too high compared to long-term norms. In simpler terms, you're paying a huge premium today for future success. And if that success gets delayed by even one quarter, the stock price will correct violently. There's just very little margin for error.
So what does this all mean for an investor who still needs to allocate capital in the U.S.? It sounds like an impossible landscape. You have good companies, but they're at bad prices.
It means that the need for selectivity is absolutely paramount. If you're going to invest in the U.S., you need to be incredibly meticulous. You cannot afford to just buy an index fund or a basket of average stocks and expect the market tide to carry you higher.
This fundamentally changes the investing environment, doesn't it? It moves from one where passive investment worked pretty well to one where active management is essential. The era of the easy trade is over.
It's completely over. The source makes it very clear. The era of buying the whole market, that passive approach built on the belief that a rising tide lifts all boats, is finished. Broad, generalized strategies are going to struggle.
So what do you look for?
You have to do the homework.
Yeah.
Targeted, active investments are now essential. You have to look for companies with strong pricing power, defensible business modes, low debt, and predictable cash flow. And the valuation has to be justified today, not based on a promise of what might happen 5 years from now.
Okay, let's try to synthesize all of this. What are the general conclusions and suggestions for our listener? If you could take away three strategic points from this snapshot of November 18, 2025, what are the actionable directives?
I think the sources give us three very clear, unified directives for navigating this kind of defensive environment.
Okay, what's takeaway number one?
Takeaway one is about sentiment and mindset. Market psychology has definitively shifted toward defense. There's basically zero tolerance for speculative risk and an extreme focus on valuations. So your capital planning has to reflect that. You have to prioritize cash flow and stability over aggressive expansion that's fueled by debt or high-risk capital.
Okay, mindset is defense. What's number two?
Takeaway two is about risk mitigation. High valuation is still the primary concern driving all this global fear and volatility. The most dangerous thing a leader or an investor can do right now is blindly follow momentum or market trends without closely examining the underlying financial data.
You have to look at the numbers.
You have to look at the numbers and confirm that the price actually justifies the earnings potential. Avoid anything that feels speculative.
Makes sense. And the third takeaway?
The third takeaway is about opportunity and diversification. While the U.S. is stressed, opportunity does remain if you practice calculated geographical diversification. Look at emerging markets as a relative valuation play, and look at specific foreign currencies.
Like the euro.
The euro is the key example from our sources. It signals that capital needs to be geographically mobile to find relative safety and value. You can't just rely on the traditional safety of USD-denominated assets anymore.
Wow. This has been an intensely strategic and pretty demanding deep dive into the state of the markets. Let's just quickly review the key themes that you need to take away from this.
Sounds good.
We started with that Jeffrey Gundlach warning, which is really defining this entire global shift toward defense. It's driven by the breakdown of the traditional 60-40 portfolio.
Then we looked at the shock of the euro's surprise rise as a new preferred safe harbor.
Right, which signals this deep structural distrust in U.S. stability and policy right now. And then critically, we connected that macroeconomic reality, the measurable contraction in export nations like Japan and Switzerland, directly to your operational world.
Specifically, the inevitable rise in imported equipment costs and the fragility of your supply chain.
So the key mandate coming out of November 18, 2025 is what?
I think it's this. Control valuation above all else. Prioritize liquid cash holdings so you're prepared for future opportunities when asset prices fall.
Yeah.
And diversify geographically, away from the traditional assumptions about U.S. and developed market safety.
So it's a time for forensic analysis.
Forensic analysis, financial prudence, and strategic patience.
And so here's the provocative closing thought for you to consider. Something that connects the dots between macro policy and specialized innovation. If the global economy is contracting because of protectionist measures like U.S. tariffs, as we saw specifically in the export contractions of Japan and Switzerland, what happens to the innovative capacity and the global scientific collaboration that your industry, molecular biology, and advanced testing fundamentally relies on?
That's a powerful question. Scientific progress is so often fueled by open trade, by shared capital, by these robust global supply chains of specialized components and talent.
So if economic walls are going up and capital is retreating defensively, will that protectionism inevitably slow down scientific progress?
Will a tariff prevent the next life-saving molecular discovery?
That's the question you have to ask as you're planning your next quarter's budget. We encourage you to continue exploring the implications of these shifting capital flows on specialized sectors and how these huge macro forces ultimately dictate the pace of local essential innovation. We'll see you next time on The Deep Dive.